Today, we're pulling back the curtain on something that pretty much runs the entire financial world, accounting's secret rulebook. Let's dive in.
So let me ask you something. When you see a company's financial report, how do you really know you can trust what it says? I mean, how do you know those numbers aren't just made up? It's a huge deal, right? Especially if you're thinking about investing your money or even working there. Because without a shared set of rules, financial reporting would basically be the Wild West. Just imagine it. Every company just making up its own way to calculate profit. You'd have no way to compare Apple to Google. Investing would be a total shot in the dark. Chaos. So to stop that from happening, the accounting world came up with a common language. It's called Generally Accepted Accounting Principles, or just GAAP for short. You can think of it as the official rulebook, the one thing that makes sure everyone is playing the same game, so the numbers are actually reliable and you can compare them. All right, so here's what we're going to cover. First, we'll look at how this common language is structured. Then, we'll get into the foundational concepts, the guiding conventions, and finally, pull it all together to see why these rules matter so much.
So diving into that first part, this rulebook isn't just some massive, boring list of rules. No, it's actually organized into two main parts.
Okay, so on one hand, you've got the concepts. These are the big, fundamental, non-negotiable assumptions. They're like the laws of physics for accounting. You just can't break them. Then, on the other hand, you have the conventions. These are more like customs or traditions. Think of them as the accepted best practices that guide how accountants apply the rules. So let's start with those bedrock concepts.
Right. The foundational concepts. Like I said, these are the core ideas that everything else in accounting is built on.
And the first one is a biggie, the business entity concept. It's super simple but absolutely crucial. It just means the owner and the business are two totally separate entities. They are not the same thing.
Exactly. The business has its own wallet and the owner has theirs. The company has its own bank accounts, its own assets, its own debts. The owner's personal life stays completely out of the company's books. The two never, ever mix. And this is where it gets kind of wild. Because of this rule, when an owner puts their own money into the business actually sees that cash as a liability. It's a debt that the company owes back to the owner. And get this, even the profits are technically a liability, something the business owes to its owner. Everything is seen purely from the business's perspective.
Okay, next up is the money measurement concept. The rule here is dead simple. If you can't express it in terms of money, it doesn't get recorded. Period. Accounting only speaks one language, and that language is currency.
So think about it. What's one of a company's most valuable assets? Probably its people, right? A brilliant team, fantastic morale, but you won't see that on a balance sheet. Why not? Because you can't put a reliable price tag on it. So if it can't be measured in dollars or yen or euros, it's invisible to the accountant.
All right, so that's the bedrock, the core concepts. Now let's move on to the guiding conventions. Remember, these are the traditions and best practices that shape how accountants actually do their day-to-day work.
And the first one is the convention of conservatism. This one is all about being cautious, maybe even a little pessimistic. The idea is to play it safe. You anticipate and record any possible loss you can think of, but you absolutely do not record a profit until it's a done deal.
So it boils down to this simple do and don't. Do record anticipated losses. For example, if you think there's a chance a customer won't pay you, you make a note of that potential loss right now. But don't record anticipated profits. You might be about to close a huge deal, but you can't put that in the books until the ink is dry. You prepare for the worst, but you wait for the best.
A classic real-world example of this is something called a provision for doubtful debt. Basically, a company looks at all the money it's owed and says, you know what, realistically, some of these folks probably won't pay. So they proactively account for that expected loss even before it happens. It's the definition of financial prudence.
Okay, next up is the convention of consistency. And this one is exactly what it sounds like. It's powerful, but really straightforward. Whatever accounting methods a company chooses, it has to stick with them year after year.
Why is this so important? Because it's the only way to get a true comparison over time. It makes sure you're always comparing apples to apples, not apples to oranges. That way, when you look at the numbers from this year versus last year, you know you're seeing a real trend, not just some trickery from changing the rules of the game.
Okay, so we've covered the bedrock concepts and the guiding conventions. Let's zoom out for a second. Why does all this matter? What's the big payoff for having this shared rulebook?
While the payoff is huge, first, you get reliability. Because everyone follows the same rules, you can actually trust the numbers you're seeing.
Second, you get comparability. You can put Apple's financials next to Google's and make a real comparison. And you can also compare a company's performance this year to its performance last year. It just works.
When you really think about it, this rulebook creates something much bigger than just financial reports. It creates a system of trust, and that trust is the foundation our entire economy is built on. It's what allows the whole system to function.
But here's a final thought to leave you with. This rulebook was created for a world of factories and physical stuff. Today, business is all about data, software, and digital assets. So the big question now is, how does this incredibly important rulebook need to change to keep up with the 21st century economy?